What if you could find options trades with a 90% win rate in just 3 minutes? In this video, our head of options trading is going to walk you through how to spot high odds options trades fast. This is a system you can learn to use right now in real markets. I'm Mike Bellafiore, co-founder of SME Capital, one of the top proprietary trading firms in the US with offices in New York City and Miami. We've developed numerous 7 and even 8-figure-a-year traders, and through SME training, we teach traders just like you. If you're serious about learning how pro traders use options to gain an edge, you're in the right place. Let's get to it.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And let's face it, traders are human beings, and I'm not sure I've ever met a human being that actually enjoys losing trades. While it's absolutely critical for a successful trader to accept that they were wrong and take their stop on a trade and be able to recover emotionally from that losing trade, and in fact, you've got no shot at becoming a successful trader if you don't know how to take a loss. But nonetheless, I've never met a trader who actually looks forward to losing. It's just not realistic to think that. And in fact, traders who first get started trading often find themselves gravitating towards options trading because with options, you can dictate how likely it is that you'll win a trade. And while that might sound weird or unrealistic, I assure you that it's not. And that's what we're going to be covering in today's video, just how easy it is to learn the steps necessary to set up a very high probability options trade. If you're absolutely brand new to options trading and you don't know much about how options work, we've created a video for you to understand options basics. And if you click on the video appearing on the screen right now, it will lay the groundwork for understanding the option strategies that we're going to be teaching you in this video. Then when you're finished, you can come back and watch the rest of this video. So let's jump in and show you how to do this. You're going to be surprised at how easy this actually is. Let's first take a look at a case where, for whatever reason, you've become bullish on the market. For instance, let's look back at the S&P 500 index on April 7th, a few days after President Trump announced the first version of his sweeping worldwide tariff program, which shocked the markets with its magnitude. And as a result, as you can see, the market sold off hard. And the RSI indicator for the index crashed into the low 20s, which is an extremely oversold condition, which in turn is considered to be highly bullish for the foreseeable future, as it indicates that people have panicked, what traders refer to as capitulation, and investors were dumping stocks indiscriminately, creating in turn opportunity for insightful investors to scoop up shares very cheaply. And so this actually becomes a very bullish sign for the market. And so after trading over 6,100 earlier in the year, the index now stood at 5062.25 that day, having lost more than 17% of its value in a very short period of time. And so let's say that on that day, you pulled up an options chain expiring a month later on May 7th and checked out that column, which is labeled Delta, which is a column that all options trading platforms will provide for you. So you don't have to worry about that. And you look for an option which is close to 10 deltas, which in this case is the 4200 SPX index put selling for 47.45. And you go ahead and sell that. And then for protection, you head down 100 further points to the 4100 put, and you go ahead and buy that one. Well, if you do that, selling a put higher up on an options chain and buying a put lower down on that same options chain, you're creating what options traders refer to as a put credit spread. And when the option you sold is at 10 deltas, then it would be known as a 10 delta put credit spread, which is a very high probability options trade. Now, why do we say that this is a very high probability trade? Well, to understand that, you need to understand a little bit about an options delta. You see, the delta of an option is a mathematically arrived at prediction of how much an option's price is likely to move based upon how much the stock itself moves. And while it's a little bit of a complicated topic, suffice it to say that an options delta has also been found to be highly correlated to the probability that an option will expire with value on the day that it expires. And so the delta in this case of about 10 is telling us that there is only a 10% chance that the put option we sold will have any value when it expires, meaning, naturally, that there's only a 10% chance that the index will close below its strike price of 4,200, which is way, way below where the index is trading on this day, up more than 800 points higher. And that in turn means that there's a 90% chance that that put will expire with no value on the day it expires. And obviously, there's an even greater chance that the option we bought 100 points below that will expire with no value also. Now, let's first look at the cash flow of this transaction, which is important in understanding the trade. And so when we sold that 4,200 put, we received a price of $47.45. But remember, index put options pay off at a rate of $100 per point that the index closes below the strike price of that put. And so you multiply that by 100 when calculating the cash you receive. And in this case, it produces $4,745. And in turn, the protective put you bought at 4,100 cost us $40,035 using that same kind of math, resulting in net cash flow of $710 for this trade. And your broker will require you to have at least $92.90 in your account to initiate this trade in the first place, which is also the trade's worst case scenario loss. And now, moving to the day that this trade expires, you can see that this was a pretty easy trade, right? Because the market began to bounce after the RSI index cratered into the low 20s the day we entered the trade. And the index, in fact, closed much higher on May 7th, closing at 56.3128 on the day the trade expired. And so the result of our trade is pretty easy to understand, because with the index closing at 56.3128, starting with that initial positive cash flow that we received when we first entered the trade, you can see that the 4,200 put, which expired more than 1,400 points lower than the index closing price, obviously has no value, because the index has to close below that put strike price for that option to have value. And obviously the put we bought below that is also worthless, even farther below the index closing price. And so both options expire worthless, meaning that you just pocket that cash flow that you originally received. That example was easy because we went into a trade with a bullish bias and the market bounced, and so you'd expect to win that trade. But suppose that it wasn't that easy. Suppose that the direction we thought the market was going to head was wrong. Wouldn't we lose the trade? Well, let's take a look at another example from June of 2024, where in this case, with the index trading at 5421.03, the exact opposite happened. And the RSI indicator pierced the 70 level, which is normally considered to be an overbought condition, which is also normally perceived to be a bearish signal. And so when that happens, if you're looking for a very high probability trade, you could consider basically the exact opposite trade than the put credit spread that we just showed you. And this opposite trade is known as a call credit spread. So very similarly to what we did last time, we look for a 10 delta option, but in this case, we're looking for a 10 delta call option. Why? Well, think about it. Remember, we told you that a 10 delta option has only a 10% chance of expiring with value on the day it expires, and therefore a 90% chance of expiring with zero value. And isn't that what we'd want? You see, because with index call options, they only have value if the index closes above their strike price on the day the option expires, the opposite of a put option. Then, when you're feeling bearish, what you want to do is sell a call that's way above the index price and buy a protective call even higher than that. And so that's exactly what we would do on that day. You see, the 10 delta call on that day was the 56.25 call selling for $6.95. And so if we sell that call and buy the 5700 call with a price of $2.45, then in this case, we've created the call credit spread, which is a bearish trade. And again, as in the case of the put credit spread, you can see you receive positive cash flow for this trade, receiving more for the call you sold than for the call you bought, which makes sense, right? Because the call you sold is more likely to pay off than the call you bought higher up on that options chain, which is farther away from the market price and less likely to pay off. So the market will pay more for the one you sold than the one you bought, resulting in positive cash flow, which in this case is $450, as you can see from the calculation. A trade which requires capital of $7,050, the trade's worst case scenario. But in this case, well, it turns out that the supposed overbought conditions weren't overbought at all, and the index just kept on rallying after the overbought indicator signaled bearishness. And it ended up nearly 200 points higher, closing at 56.1535 on the day the trade expired. And so we couldn't have been more wrong. And with pretty much any other trading vehicle, we would have just lost this trade. But let's take a look at what happened in this case. You see, while the index rallied, it fell short of hitting 56.25, which is the location of our short call. And therefore, that expired worthless. And of course, the index closed even farther below the 5700 call, which therefore also expired worthless, meaning, again, as in the case of the put credit spread, this call credit spread expires completely worthless and we win $450, the original cash flow. Are you surprised? I mean, did you expect to win a trade where your trade premise was so completely, miserably wrong as it was in this case, where the index rallied almost 200 points higher against our position, and yet we still won? Well, think about it. Should you be so surprised? Remember, in the beginning, we told you that 10 delta options are 90% likely to expire worthless. Well, there's a reason for that, and that's because 10 delta options are located so far away from where the index is trading that even if there is a significant move against your position, you can still make your entire positive cash flow profit on the trade as long as on expiration day, the strike price is farther from the market than the index closing, even if it's only slightly above that closing price, as was the case in this call spread example that we just showed you. Of course, once it gets past that strike price, then the short option you sell will start paying off and you're likely to lose the trade. But the chances of that happening are, as we said, about 10%. And so what I'd like you to take away from today's video is that with options trading strategies, you are in the driver's seat in terms of determining the probability that a trade will be profitable. And so if you're a beginner or simply someone who wants to experience a high win rate on trades, as we've just demonstrated to you, options trading gives you the ability to construct your trades in such a way that there's an excellent chance that you'll win. With credit spreads, the farther you are from the money, the more likely you'll win the trade. That's just the mathematical fact. Professional options traders are well aware of the deltas of options and use deltas as a metric all the time to control their risk and to maximize their win rates, as we just showed you in today's video.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.